Hello everyone, welcome to the subject F7 and today we will be learning about inventory. Now, inventory falls under IAS 2. Let us start things off first with the definition of inventory. By definition, inventory are assets held in the ordinary course of the business, meaning if we are selling cars, this means that the cars in the showroom would be our inventory. Why? Because we are selling it in the ordinary course of the business. Inventory can also be assets which are in the process of production. This means that it is not 100% complete. This is what we usually call work in progress. And it is in the form of materials for the production process. Now, from the definition stated, I can conclude that there are four types of inventories. Okay. First one is what we call finished goods, mean it's 100% complete, and now we are going to sell it off to our customers. Second one is what we call raw materials. This means that these are still materials which are going to be used in the production process. Third one is work in progress. Work in progress simply means that they are not raw materials, but they are not finished goods. This means that they are still in progress. It is in between a raw material and a finished good. And the fourth one is what we call as goods purchased for resale. Now, what does goods purchased for resale mean? This simply means that sometimes what our customers want, we can't actually produce it. Hence, what we do is we buy it as a finished good from another company. So you can say it as an outsourcing process. Now, once we already have the finished good, then we will actually sell it to our customers. So these are the four types of inventory. Now, how do we actually recognize inventory? Remember, inventory is an asset, hence it has to meet the criteria. Okay, now this is how we are going to recognize our inventory. It must be probable that future economic benefits will flow. In simple terms, this means that there's a good chance, or you can say a chance which is above 50% that we are going to receive income from our inventory. And the other one is the cost can be measured reliably. Now, how do we measure inventory? Okay, these three things are very important for your F7 exam and you should know them. First one is the purchase price plus any transport and handling costs plus import costs minus any trade discount you obtain. Second one is cost of conversion. Cost of conversion is simply the cost which you have to incur to ensure your raw materials become finished goods. These things are usually the direct, directly related costs, such as direct labor and direct expense. Now, the third one is any other cost incurred in bringing the inventory to its present condition. You must remember these things to include as your cost of inventory. Okay, now, how do we value inventory? IAS 2 tells us to value inventory at the lower of two things. Okay, we are going to value inventory at the lower of two things. One is the cost of the inventory, and the other one is the net realizable value. Now, to calculate net realizable value, we simply use this formula. Okay, to calculate NRV or net realizable value, we simply calculate it by using this formula. Selling price minus the cost to sell. Say an example of cost to sell would be, in order to sell our inventory, we would have to pay commission or we would have to profit share. Now this is what we call a cost to sell. Okay, we are going to value it at the lower of them. Now, cost we usually use either FIFO, or you can say the first in first out, or the AFCO method, average cost method. Now remember, the traditional way used to also include LIFO, or last in first out, as the valuation of inventory under cost. But now IAS 2 prohibits us from using LIFO. Hence, we only use FIFO and AFCO. Okay, let's try to do an example to make things more clear. Now, ACO had the following products. 3 products, each individually named Alpha, Beta, and Charlie. Now, the cost of Alpha is $10, the selling price of Alpha is $13, and to sell he has to pay a commission of $2. When it comes to Beta, our cost is $15, we can sell it for $18, but we have to pay a commission of $4. Now, for Charlie, our cost is $22, our selling price is $25. However, to sell it, we will also have to pay a commission of $5. Now, it says calculate the value of ACO's inventory at year end, assuming they have 100 units of each. Now, when a question like this comes up, always remember, when it comes to valuing inventory, we will use IAS 2. IAS 2 tells us to value inventory at the lower of two things. One is the cost, and one is the net realizable value, or we say NRV. Now, let us try doing it for each product first to understand things simpler. If you can see, product Alpha, the cost is $10. Yes? Now, if you see, my selling price is $13. However, I have to pay a commission of $2. This means that my NRV is actually $11. Yes? Now, what would be the NRV for product Beta? If you see here, it would be $14. And product Charlie would have an NRV of $20. Yes? Now, IAS 2 tells us to take the lower one. So, seeing product Alpha first, we would take $10. Yes, why? Because it is lower. Product Beta, we would take $14 because it's lower. And product Charlie, we would also take $20 because it is lower compared to our cost of $22. So, when we value the inventory at year end, we would value it this way. I have 100 units of Alpha, and I will value it at $10 each. Yes? Now, I have product Beta, I have 100 units, and I will value it at $14 each. And I have product Charlie of 100 units, and each one I would value it at $20. This would mean this would end up to $1,000 plus $1,400 plus $2,000. hence leading to an answer of $4,400. Okay, so at the year end, ACO's inventory is actually having a value of $4,400. This is based on the principles of IAS 2, where we value inventory at lower of cost and net realizable value. Remember, net realizable value is made up of your selling price minus any cost to sell the good or the inventory. Okay, that is it for your IAS 2. If you have any questions, please feel free to send them in the address shown below. Thank you for watching this video and hope to hear from you guys soon. Hello everyone, welcome to the subject F7, and today we will be learning about agriculture. Now, agriculture is probably one of the newest things which have been introduced to the subject F7. Agriculture falls under IAS 41. When it comes to agriculture, there are very important definitions which we will have to learn. So let us first start it off with that. Now, this topic talks about agricultural activity. Agricultural activity is the management by an entity of the biological transformation of biological assets for sale into agricultural produce or into biological assets. Now, reading this definition might still seem quite confusing, but we will be going through various definitions which will make things much simpler. Now, let us first start it off with biological transformation. Biological transformation is the process of growth, degeneration, production, and procreation that causes qualitative and quantitative changes in a biological asset. Now, you might be wondering first, what is a biological asset? Biological assets are simply living plants or animals. Now, let's reread again the definition of agricultural activity. The management by an entity of the biological transformation of biological assets for sale into agricultural produce or into biological assets. In simple terms, agriculture talks about how, as a business, we are going to manage the biological transformation. Biological transformation talks about the processes such as growth, degeneration, production, and procreation. Okay, and these talks about biological assets. Biological assets are living plants or animals. Now, let's read further definitions. Fourth one is what we know as harvest. Harvest is the detachment of produce from a biological asset or the cessation of a biological asset's life. An example would be like this. If I take an apple from an apple tree, this means that I am detaching a produce from a biological asset, which is the tree. Or you can say when a cow or a chicken passes away, then I take their meat. This is what we call harvest. Harvest is the detachment. The key word here is detachment. Okay, and the fifth definition we're going to learn is agricultural produce. It's the harvested products of an entity's biological assets. This means that, like my previous example, if I take out an apple from an apple tree, the process is what I call harvest. But the item that I get, meaning the apple, this is what I know as an agricultural produce. Okay, these definitions are very important, so let's go through them once again. Agriculture activity is the management by an entity of the biological transformation. Wait a minute, remember, biological transformation talks about the processes of biological assets, such as plants and animals, for sale into agricultural produce or into biological assets. This means that I want to manage the biological assets of my company to ensure that I have an output from them, what I call as an agricultural produce, or into further biological assets. Okay, this is what agricultural activity means. Biological transformation talks about the processes such as growth, degeneration, production, and procreation. I will be explaining these four in a little while. Now, biological assets, as I said earlier, are living plants and animals. Harvest is the process of the detachment of the produce, or you can say the output, from a biological asset, or the cessation of a biological asset's life. Cessation means the end of a biological asset's life. In other words, the animal is now no more. And fifth is agricultural produce. This is what we get from the harvest. Now, talking about biological transformation, okay, there are four things we saw earlier: growth, degeneration, production, and procreation. Let us first start off with growth. Okay, let us first start off with growth. Growth means there is an increase in the quantity or quality of a biological asset. Say if my cow now becomes fatter, this means it has more meat. This is what I call growth. It's an increase in the quantity or the quality of a biological asset. Degeneration is the opposite of growth. This is a decrease. Okay, remember growth is increase. Degeneration is talking about a decrease in the quantity or quality of a biological asset. Say if my cow is now becoming old or becoming thinner, this means that now my meat is less. This is what I call as degeneration. Production talks about a separable non-living item produced by a biological asset. Okay, the keyword is separable non-living item. A good example would be, say if I get milk from my cow. Now this is separable, meaning I can take it out and it is a non-living item. And this is produced also by a cow, which means it is produced by a biological asset. Procreation simply means that the biological asset is now making another biological asset. This is what I call procreation. Yeah, this is the process in which, say, my cow has now a child or few children. This is what I call procreation. So these are the 4 definitions under the term of biological transformation. We have talked about the definition of agriculture. Now let's next talk about the recognition criteria. By now you should be knowing that we are talking about biological assets. Yes, this means that these are living plants or animals. Okay, now from the word asset, you know that we already have a recognition criteria. First one is these are the 3 criteria that has to be met in order to classify them as a biological asset. First one, control by an entity as a result of past events. Next is probable future economic benefits will flow to the entity. This means that there's a good chance that income will actually enter our company because of the asset. And the third one is the cost or the fair value of the asset should be measured reliably. Now once we recognize it, then we are going to measure our biological assets. Okay, to measure our biological assets, we are going to measure them in accordance with IAS 41. IAS 41 states that we should always value our biological assets at fair value minus point of sale cost. Now, fair value, this is what you know as market value, meaning the price if we buy it today. And point of sale cost is the cost which we will have to incur when we actually sell the biological asset. Now, for initial recognition, IAS 41 actually states a simple rule. Okay, if when it comes to initial recognition, if the fair value cannot be measured due to various reasons, then we will value the biological assets using this formula: cost minus accumulated depreciation minus accumulated amortization. Okay, this is how we are actually going to measure our biological assets. But first, at the end of the day, we always have to value our biological assets at this formula: fair value minus point of sale cost, unless IAS 41 gives a special rule for initial recognition. When the fair value cannot be measured, then we will value it at cost minus accumulated depreciation minus accumulated amortization. Now, these are additional points which you have to note in regards to IAS 41. Okay, three important notes to take into account of. First one is biological assets are usually classified as non-current assets. Now, next one is once harvest takes place and we want to actually sell the agricultural produce. Supposing if my business sells meat. Now, my cow passes away and I take away the meat. This is what I call harvest. Yes, the process of taking out the meat is what I call harvest. The meat itself is an agricultural produce. Now, but my business, the line of my business is actually selling meat. Hence, now if I want to sell the meat of the cow, IAS 2 is being applied here. Okay. The third note is any gain or loss in the fair value of biological assets will be recognized in the profit and loss statement in the current year itself. That is it for your IAS 41. If you have any questions, please feel free to drop them in the address shown below. Thank you for watching this video and hope to hear from you guys soon.